Isn't it wild to think about how much cryptocurrency is just, well, sitting there, earning returns for its holders?
It really is. We're talking serious numbers in staked assets alone.
Yeah. And some people are quietly building wealth just by, participating in these networks. Okay, let's unpack this, because this isn't about the roller coaster of trading, right?
Not at all.
For this deep dive, we're going way beyond just buying low and selling high. We're exploring the world of generating passive income with crypto in 2025.
Exactly. And we've pulled together quite a range of resources for you. Everything from guides on crypto exchanges with, really low fees.
Okay.
To clear explanations of things like crypto airdrops, and then deep dives into staking, lending, and those fascinating liquidity pools.
And we're also looking at market reports.
Yep. Insights from the latest CoinDesk quarterly market report, and even some candid experiences shared by crypto users on Reddit. Gives you a real feel for it.
Okay, good. So our goal today is simple, really. To give you the understanding you need to explore different ways to potentially grow your crypto holdings without constantly watching those price charts.
Right. We'll break down methods with different levels of risk, different effort involved.
And crucially, help you navigate that whole landscape of fees and opportunities, which can be, well, a bit complex.
Definitely.
So, ready to get into it?
Let's do it.
Let's start with a popular one. Staking. What's the fundamental idea behind it?
So, at its heart, staking is about holding and essentially locking up your cryptocurrency. You do this in a digital wallet to support the security and operation of a proof-of-stake blockchain.
Okay, so like contributing to keep the network running.
Exactly. Think of it as participating in the validation process. And in return, you get rewards.
And compared to other methods, this one's safer, generally.
Generally speaking, yes.
Yeah.
Staking is often seen as more foundational and lower risk compared to some of the other things we'll cover.
Okay, so you commit your coins, you get something back. What are the real advantages here? What makes it attractive?
Well, the potential advantages are quite appealing. You typically get regular rewards, and in many cases, they're fairly predictable.
Sort of like earning interest.
That's a good analogy, like interest in a traditional savings account, yeah.
Yeah.
Plus, by staking, you're actively supporting the network's operations.
Right, which people in the community value.
Exactly. It contributes to the ecosystem's health.
Sounds pretty good. But
Yeah.
there's always a flip side, right? What are the potential downsides, the catches?
You're right to ask. There are definitely things to consider. First, you need an initial investment. You obviously have to own the crypto you want to stake.
Makes sense.
Second, many platforms have lockup periods.
Ah, okay. So your coins aren't liquid.
Right. Your staked assets can't be easily accessed or traded during that time. For example, Polkadot has a 28-day unbonding period if you want to unstake.
28 days. Wow, okay.
Yeah, so that lockup isn't just an inconvenience, it's a commitment. It affects how you can react to market changes.
And longer lockups usually mean higher rewards, I guess.
Often, yes. You're trading that short-term flexibility for potentially better long-term gains.
Okay. And what else?
Well, your returns can also be affected by the network's overall performance, and naturally by the price swings of the token you're staking.
Right. The value can still go up or down.
Yeah.
So which cryptos are we talking about here? What are people actually staking?
Our sources highlighted several popular ones. Ethereum, obviously, since it's moved to proof of stake. It's a 2.0 upgrade. Then you've got Cardano, ADA, Polkadot, DOT. Even Chainlink, LNK, has introduced staking now.
Oh, interesting.
Yeah, to boost its network security. Algorand, ALG, and Icon, ICX, were also mentioned.
And where do you actually do this staking? Is it complicated? Do you need special software?
The complexity can vary. Big exchanges like Binance offer staking services directly on their platform.
Oh, okay. That sounds easier.
It can be. They were specifically mentioned for staking Algo and ICX, but there are also dedicated platforms that specialize in it. Maker and Cool Wallet were noted as reputable options there.
Got it.
And it's worth mentioning Chainlink's concept of superlinear staking, too. It's designed to scale security efficiently.
Okay. And just to be clear, this is different from mining Bitcoin, right?
Totally different. Staking is for proof-of-stake systems. Mining is for proof of work, like Bitcoin. Mining uses computing power to solve puzzles.
Right, the energy-intensive one.
Exactly. Staking relies on holding and locking up coins to participate in validation. Yeah. Much more energy efficient.
Got it. So staking, kind of like a crypto savings account, helps the network. Now, yield farming. That sounds like it takes things up a notch. What's that all about?
That's a good way to put it, yeah. Yield farming definitely takes things further. It involves lending or staking your crypto, but specifically on decentralized finance or DeFi platforms.
Okay, DeFi.
Right. And the main goal is earning returns, maybe interest, maybe additional crypto tokens by providing liquidity to these platforms.
Providing liquidity. So, like, making sure there's enough crypto available for trading on those platforms.
Exactly. You're helping facilitate trading and other activities in these decentralized marketplaces.
Okay, so the potential rewards probably higher with yield farming.
That's the draw, yes. Yield farming often offers the potential for higher returns than standard staking.
And more flexibility, maybe.
Sometimes, yeah. You might be able to move your assets between different platforms, chasing better yields.
But I'm sensing a but here. Higher
Wow.
potential rewards usually mean...
Higher risks,
Yeah.
absolutely. Yield farming has a significantly higher risk profile.
Okay, like what?
Well, a big one is smart contract vulnerability. These DeFi platforms run on code, right? Self-executing contracts.
Mhm.
And there's bugs in that code, or if it gets exploited by hackers, your funds could be at risk. Gone.
Oof. Okay, that's serious.
It is. Then there's something called impermanent loss.
Impermanent loss. I've heard that term. It sounds counterintuitive.
It can be tricky. Imagine you put equal value amounts of two tokens, say token A and token B, into a liquidity pool for trading.
Right.
If the price of token A suddenly skyrockets while token B stays flat, the pool automatically rebalances. You might end up with fewer of the valuable token A and more of token B than if you just held them separately.
So you lose out on some potential gains compared to just holding.
Exactly. The loss is the difference in value compared to simply holding. It's not necessarily a loss against your initial deposit, but it's a potential opportunity cost.
Got it. That makes sense. Anything else?
Yeah, the value of the tokens you're farming can be incredibly volatile. That obviously impacts your returns. And just managing assets across multiple DeFi platforms can get really complex really fast.
So which platforms are we talking about here? The big names?
Yeah, reputable platforms often mentioned include Uniswap, and Compound. But even with reputable ones, the risks remain.
Right. High risk, potentially high reward.
Okay, let's shift to something that sounds maybe a bit more straightforward. Crypto lending. You lend crypto, earn interest. Is it that simple?
That's the basic idea, yeah. Platforms and protocols connect lenders, people with crypto they want to earn interest on, with borrowers.
And you earn interest on your deposited crypto?
Correct. You're essentially acting like a bank for other crypto users. Returns often mentioned are somewhere in the 5% to 15% range.
That's pretty appealing compared to traditional rates.
It can be, yeah. And a key benefit is you don't have to sell your assets to generate that income. You keep your underlying crypto.
So who's borrowing this crypto, and what are the main risks for me, the lender?
Borrowers can be individuals, institutions, even other DeFi protocols sometimes. The main risk for you as the lender is counterparty risk.
Meaning the borrower might not pay it back?
Exactly, the risk of default. Then there are platform security risks. If the lending platform gets hacked,
Your funds could be stolen. Potentially, yes. Also, the value of the collateral borrowers put up can fluctuate, which affects the security of your loan. And like always in crypto, there's regulatory uncertainty hanging over things.
which platforms facilitate this?
BlockFi, Celsius, Nexo, and Aave were mentioned in our sources for crypto lending. Though it's worth noting, some of those have faced challenges, reinforcing the platform risk point.
Definitely need to do your homework on the platform itself. Okay, we've hit staking, yield farming, lending. Now, liquidity pools sounds related to yield farming, but is it the same thing?
Not exactly the same, but they're very closely related. Both live in that DeFi ecosystem.
Okay.
Liquidity pools involve contributing your assets, usually pairs of tokens, to these shared pools on decentralized exchanges, DEX.
Like Uniswap again.
Exactly. Uniswap, SushiSwap, Balancer, those are key examples. These pools provide the liquidity needed for people to trade tokens on the DX.
And why would I contribute my assets? What's in it for me?
In return for providing that liquidity, you earn a portion of the trading fees generated by the DX whenever someone trades using your pool.
Ah, okay. So you get a cut of the action.
Pretty much. Plus, sometimes you might get additionally reward tokens on top of the fees.
So the main draw is earning those trading fees.
That's a big part of it, yes. You earn a small slice every time a trade happens in your pool. Plus, you're actively supporting the DX and the whole DeFi movement, which appeals to some people.
And the downsides, I'm guessing.
Impermanent loss, again, that's the primary risk here, just like with some forms of yield farming.
Right. If the price ratio of your two tokens changes too much.
Exactly. You could end up with less value than if you just held the token separately.
Yeah.
Managing these pools effectively also requires a pretty good understanding of how the paired assets interact. It can be complex.
Okay, makes sense. We've covered some major methods. Our outline also mentioned some other, maybe less common ways to earn passively. What were those?
Yeah, there are several others, though they often have quite specific requirements or risk levels. Masternodes, for instance.
Masternodes?
Yeah, they can offer pretty high rewards, but usually require locking up a large amount of a specific crypto and running a dedicated server 24/7. Needs technical know-how and significant capital.
Okay, not for everyone. What else?
Dividend-paying tokens. These aim to give regular payouts, kind of like stock dividends, often from project profits or fees.
But risky if the project fails.
Absolutely. Their success is completely tied to the underlying project. Then there's cloud mining.
Renting mining power.
Essentially, yes.
Yeah.
No hardware needed on your end, but it's an area known for scams, and profitability is often lower due to fees. High risk.
Got it. NFTs, can you earn passively there?
If you create NFTs, you might earn royalties from secondary sales, but it's highly speculative, totally dependent on your NFT's ongoing popularity.
Very hit or miss, I imagine.
Definitely. And finally, crypto savings accounts. Platforms like BlockFi, Celsius, Nexo, Binance offer these. More straightforward, earn predictable interest.
But probably lower rates.
Generally lower rates than, say, successful yield farming, yes. And you still have platform risk, the platform having issues.
Okay, that's a good rundown of the different avenues. Now, a really fundamental part of all this is actually buying and selling crypto in the first place. Let's talk exchanges and fees. Why are low fees so important? Seems obvious, but...
It seems obvious, but the impact can be surprisingly big, especially if you trade frequently. Every little fee eats into your potential profits. Choosing an exchange with competitive fees is just, well, basic financial hygiene in crypto. It makes your capital work harder for you.
And what about those places advertising zero fees? Is that for real? Or is there a catch?
There's almost always a catch. Zero fees sounds great, but it's often more marketing than reality.
Oh, so?
Well, they might not charge a direct trading fee, but they might make it up elsewhere, maybe higher fees for deposits or withdrawals, or more commonly, they might have a wider spread.
The spread, that's the difference between the buying and selling price.
Exactly. The difference between the highest price a buyer will pay and the lowest a seller will accept. A wider spread means you implicitly pay more when you buy and get less when you sell. So zero fee rarely means zero cost.
Sneaky. So what are some actual ways to reduce the fees we do pay on exchanges?
There are a few good strategies. One common one is using the exchange's own native token.
Like BNB on Binance.
Precisely. Using BNB to pay fees on Binance often gets you a discount. OKX does something similar with their OKB token.
Okay, what else?
Trading volume is another factor. Many exchanges have tiered fee structures. The more you trade, the lower your fee percentage becomes.
So high-volume traders get better rates.
Usually, yes.
Got it. Minimizing fees is crucial, but it can't be the only thing, right?
Yeah.
What else is really important when picking an exchange?
Oh, absolutely not. Fees matter, but security should be your absolute #1 priority.
Right. Hacks and scams are still a big problem.
A huge problem. You need to look for exchanges with strong security measures. Things like storing most funds in cold wallets, offline storage, mandatory two-factor authentication, 2FA, and ideally proof of reserves.
Proof of reserves,
Yeah.
showing they actually hold the assets.
Exactly. Demonstrating they have enough assets to cover user deposits. It's becoming increasingly important for trust. Our sources mentioned a study ranking Binance, Crypto.com, FTX, and Gemini well overall for security.
Although FTX obviously had other massive issues later.
A crucial point, yes. Shows security isn't the only aspect of trustworthiness. Another source survey indicated Binance was most trusted by respondents at that time.
Okay, so security first. What else?
Liquidity, very important.
Meaning lots of buyers and sellers.
Yes. High liquidity means trades execute faster, usually get better prices, and there's less slippage where the price moves against you between placing and executing the order, especially vital for larger trades or less common altcoins.
Which exchanges are known for good liquidity?
Binance and Kraken were highlighted, particularly for altcoins.
Okay. What about tools and features?
For more advanced traders, yeah, the range and quality of trading tools matter. Bybit and KuCoin were mentioned as platforms offering good tools.
And the number of coins available.
The range of assets, definitely. If you want to trade lots of different altcoins, some exchanges are better than others. KuCoin was noted for a wide altcoin selection with minimal costs. Binance has a massive selection overall. Kraken also supports many altcoins.
And for beginners, maybe something simpler.
Exactly. The user interface. How easy is it to navigate and use? Beginner-friendly platforms like BingX were mentioned as being less intimidating.
That's a really comprehensive checklist: security, liquidity, tools, asset range, usability, and then fees.
Pretty much, yeah. You need to weigh all those factors.
Okay, so which exchanges did our sources specifically flag as having particularly low fees, keeping those other factors in mind?
The ones mentioned were Best Wallet, Binance, OKX, Bybit, KuCoin, MEXC, BingX, and MargX.
And they each have different strengths.
Yeah, the sources pointed that out. Like Best Wallet, positioned as a good non-custodial option for beginners. KuCoin for altcoins. MEXC highlighted for futures traders liking low fees. You need to see which fits your needs.
It's interesting that some can offer such low fees. What's the business model? How do they make money if fees are tiny?
It often comes down to volume. Like one source said, volume, baby, volume. Low fees attract tons of traders. Even tiny fees add up when multiplied by millions of transactions daily. It generates huge revenue.
So it's a numbers game.
Largely, yes. Plus user loyalty. If you feel like you're saving money, you're more likely to stick with that platform.
The psychology of a good deal.
Exactly. Positive word of mouth helps too. Sometimes it's a perception thing. The actual savings might be small per trade, but it feels cost efficient.
And sometimes it's like a lure.
Could be. A loss leader strategy. Offer super low fees on basic spot trading to get you in the door. Then make money on other services. Margin trading, futures, premium features, withdrawal fees maybe.
Right. Always look at the total cost. Okay, we've covered buying, selling, exchanges. Let's switch gears to something that sounds almost magical. Crypto airdrops. Free crypto. What are these?
Yeah, they can sound like that. Airdrops are basically distributions of free crypto tokens directly into people's wallets.
Why would anyone give away free tokens?
It's usually a marketing strategy for new projects, a way to create buzz, raise awareness, and get their token into the hands of lots of potential users quickly.
Spread the word, build a community.
Exactly. Sometimes it's also to reward loyal users of an existing platform. For you, the recipient, hey, it's potentially free crypto to add to your portfolio. Could be traded or held.
So it feels like free money. Are there different kinds? Or is it just random tokens appearing in your wallet?
Well, first, remember the value depends entirely on the project succeeding, right? It's not really free money until it has stable value. And yes, there are different types.
Okay.
There's the standard airdrop where tokens just get sent to eligible wallets based on certain criteria, maybe holding another token, for example.
Right.
Then there are bounty airdrops. These require you to do something.
Like tasks.
Yeah. Share a post on social media, write a blog review, refer friends. You complete tasks to earn the tokens as a reward. Each airdrop has its own rules.
How do you even find out about these? And participate? Seems like you'd need to be really plugged in.
Staying informed is key, yeah. Following crypto projects you like on social media, subscribing to newsletters, being active in their communities like Discord or Telegram, that's where announcements usually happen.
So you have to be proactive.
Often, yes. Sometimes just holding a specific crypto in your own wallet by a certain date, a snapshot date, makes you eligible automatically. For bounty ones, you obviously have to do the tasks.
Okay. Now, anything free in crypto makes my spidey senses tingle. Scams must be a huge issue here.
Oh, absolutely. Huge issue. As airdrops got popular, scammers piled in.
So what's the #1 rule?
Never, ever share your private keys. Ever. No legitimate airdrop will ever ask for your private key or seed phrase. That gives them full control of your wallet.
Okay. Critical point, never share keys. What else?
Always verify the source. Double, triple check. Scammers are good at impersonating real projects, fake websites, fake social media accounts. Be super skeptical of offers that sound too good to be true. They usually are.
If it promises guaranteed riches for clicking a link, run away.
Pretty much, yeah. Check official channels only.
So why do projects do this? Beyond marketing, what's the goal?
Marketing and awareness are the big ones. Get the token widely distributed, build a community fast. It can also reward early supporters or loyal users. And sometimes it's part of a strategy for decentralization, getting the token held by many different people, not just the founders or early investors.
Okay, so are they really free money then, or are there other catches besides scams?
Well, like I said, the tokens only have real value if the project actually succeeds. Many don't. The tokens could become worthless.
Right. Potential value, not guaranteed.
Exactly. Also, depending on where you live, you might owe taxes on the value of the airdrop tokens you receive.
Taxes. The other certainty in life.
Pretty much. So yeah, airdrops can be a nice potential bonus, but approach them with realistic expectations. Always do your own research on the project itself. Don't just grab any free token offered.
Good advice. Do your own research. DYR applies here too. Okay, we've looked at individual strategies. Let's zoom out now. Market trends. Our sources included a CoinDesk quarterly report for Q4 2024. What were the big takeaways?
Yeah, that was interesting. The CoinDesk 20 index that tracks the top digital assets surged over 60% in Q4 2024.
Wow, 60%.
Yeah, a strong quarter. And interestingly, it outperformed Bitcoin in that quarter, which hadn't happened since Q4 of the previous year.
So altcoins had a good run.
Some definitely did.
Yeah.
But the report also really highlighted Bitcoin's strengthening status as a legitimate institutional asset.
Driven by the ETFs.
Largely, yes. The U.S. spot ETFs launched earlier that year had accumulated over 1 million Bitcoin by then. And in Q4 alone, they saw net inflows of nearly $12 billion.
Huge numbers.
Massive. Plus, publicly listed companies also kept buying, adding around 229,000 Bitcoin in Q4. So serious institutional adoption continued.
Okay, big institutional flows into Bitcoin. What about the rest of the market? You said the CD20 outperformed Bitcoin.
Right. It was noteworthy that some Layer 1 coins from the previous cycle, things like Hedera, XRP, Stellar, actually significantly outperformed the market in Q4.
Interesting. Older coins making a comeback.
It seems so, in that period at least. And historically, the report noted, when Bitcoin is in an expansion phase, altcoins can often show strong relative performance. This can lead to shifts in Bitcoin dominance, like we saw back in 2017 and 2021.
So the percentage of the total market cap held by Bitcoin can fluctuate.
Exactly. Which is why broad-based indices like the CoinDesk 20 are increasingly important, as Bitcoin is now less than 60% of the total digital asset market cap. You need to look broader.
Makes sense. What about Ethereum? The number 2 crypto, how did it fare?
Well, Ethereum actually underperformed both Bitcoin and some other big layer ones like Solana and Binance Chain in that cycle.
Really? Even with the move to proof of stake?
Yeah. Ether's price went up about 28% in Q4, but relative to Bitcoin, the ETH-BTC ratio hit its lowest point since early 2021.
Why might that be?
The report didn't give a single reason, but it did suggest that Ethereum's strong track record on security and reliability, plus the dominance of its Ethereum virtual machine, EVM standard. Well, that could still position it well for institutional adoption down the line.
So maybe institutions are still focusing on Bitcoin first, but Ethereum could be next?
That's a possibility the report hinted at, yeah. Potentially renewed interest in capital flows in the future. And CoinDesk is also launching new indices, like CoinDesk 80 for assets outside the top 20, and even a meme coin index.
A meme coin index. Okay, that captures a specific volatile segment.
Definitely volatile, yeah. It shows how diverse the market's becoming.
We touched on mining versus staking earlier. Just to quickly revisit that core difference again.
Sure. Core difference is the consensus mechanism. Mining, proof of work, like Bitcoin, uses lots of computing power to solve puzzles, validate transactions, energy intensive. Staking, proof of stake, like current Ethereum. Validators lock up crypto stake to get chosen to validate transactions. Much more energy efficient, lower barrier to entry usually.
Got it. And within mining itself, there's solo versus pool.
Yeah. Solo mining means you try to find a block all by yourself. If you succeed, you get the entire block reward.
High reward, but probably very unlikely for an individual.
Extremely unlikely nowadays unless you have massive resources. High variance in payouts, plus huge hardware and electricity costs.
So most people join pools.
Right. Pool mining combines everyone's computing power hash rate to find blocks more often. Rewards are shared among pool members, minus a fee.
So more predictable income, but smaller slices.
Exactly. More regular, smaller payouts. The downside is it can lead to centralization concerns if a few pools control too much of the network's total hash rate.
Right, that trade-off again. Okay, theory and market trends are one thing, but it's always great to hear from people actually in the trenches. Our sources included Reddit threads. What were users on Solana saying about how they make money?
Yeah, the Solana thread gave a good snapshot. A lot of people mentioned just basic holding long-term investing in SOL.
ODLing.
That classic HODL strategy, yeah. Dollar cost averaging, DCA, was also really common, buying a fixed amount regularly, regardless of price. Takes emotion out of it.
Smart, disciplined approach.
Seems popular. Staking Solana was mentioned a lot too, seen as relatively easy and safe passive income.
Makes sense, fits what we discussed.
Definitely. Some users are more active participating in liquidity pools within Solana's DeFi scene, or actively trying to trade the volatility.
Riskier plays.
For sure. Interestingly, quite a few mentioned generating income by actually building in the space, software development, marketing, community stuff within Solana or Web3 generally.
Oh, right. Contributing skills, not just capital.
Exactly. Airdrops came up too as potential gains, and inevitably, speculating on meme coins.
Ah, the meme coins. High risk, high reward. Maybe.
Extremely high risk, yeah. Lots of people acknowledged how hard it is to time the market perfectly. Many talked about the practical reality of working a normal job to get funds to invest in crypto.
Keeps it grounded.
It does. And the discussions weren't all positive. People shared stories of losses too. One mentioned getting burned by a high-yield DeFi project that turned out to be a scam.
Ouch. A good reminder about that DeFi risk.
Definitely. Underlines the need for extreme caution and research.
So, a realistic mix of strategies, successes, and warnings. Any other quick takeaways from Reddit?
Just brief mentions of general interest forums like Our Bitcoin Beginners and Our Crypto Markets, showing lots of ongoing questions and learning. And one user talking about switching exchanges from Coinbase to Kraken, which just reinforces how much thought people put into choosing the right platform. Weighing those factors we talked about. Fees, security, assets.
It really matters to users. Okay, throughout all this, we've kept mentioning risks. Staking, farming, lending, pools, exchanges. Nothing is risk-free here, is it?
Absolutely not. That's probably the single most important takeaway. Every single method we've discussed comes with its own set of risks.
Can you just quickly recap the main types of risk we need to keep in mind?
Sure. With staking, token price dropping, potential slashing penalties for validated misbehavior. With yield farming and liquidity pools, smart contract bugs or exploits, impermanent loss, asset volatility. With crypto lending, borrower default, counterparty risk, platform hacks or failure. Even with simpler savings accounts, platform risk is still there.
And underlying all of it is just general market volatility.
And regulatory uncertainty. It's crucial to understand these risks before you put any capital in.
So the mantra is,
do your own research. Understand what you're investing in. Understand the platform. Use strong security practices, secure wallets. Never share private keys. Verify everything. Be skeptical. Remember, searches for crypto hacking and security are rising for a reason. Vigilance is key.
absolutely critical advice. Wow, this has been a really thorough deep dive. We've covered so much ground on passive crypto income. To wrap things up, can you give us that quick summary again? The main ways to potentially earn.
Certainly. We've explored several key avenues. Staking earning rewards for supporting proof-of-stake networks. Yield farming, providing liquidity on DeFi platforms for potentially higher but riskier returns. Crypto lending, earning interest by lending out your crypto. Liquidity pools, earning trading fees on DXs. And crypto airdrops, receiving free tokens, usually for marketing.
Plus those other niche methods like masternodes, dividend tokens, etc.
Exactly. And the crucial point is that every single one has a unique balance of potential reward versus inherent risk.
So for someone listening now intrigued, wanting to explore further, what's your main piece of actionable advice?
My primary advice is start with research, deep research. Figure out which methods might align with your personal risk tolerance, your technical comfort level, and the capital you are prepared to potentially lose.
Know thyself, basically.
Pretty much. The platforms and cryptos we mentioned today, they're just starting points for your own investigation. Don't just jump in. And always prioritize security. Be deeply skeptical of anything promising unrealistically high returns.
If it sounds too good to be true.
It probably is.
Excellent. Finally, to leave our listeners with something to chew on, here's a thought. As this whole crypto landscape keeps evolving so fast, new financial tools, more big institutions getting involved, how do you see these passive income methods changing? How might they mature? And what completely new opportunities or maybe new unforeseen risks might pop up for individual investors like you in the coming years?
That's a great question to ponder. The space certainly won't stand still.
Definitely food for thought. Thank you so much for sharing all this insight today. And thank you for joining us for this deep dive.